Hi everybody, welcome. Just giving the rest a few minutes to come on. Don't worry, we're here on time. Just giving everybody a few minutes to come on. Everybody, just 2 more minutes. Hoping to have a very sharp and efficient session. The video will be available on YouTube after. I know it's pretty short notice. So for anybody that didn't get to tune in or tune into the entire thing, planning to keep it very short and efficient, and the video will be on YouTube. All right, 1 more minute. All right, let's go. So, welcome. Thanks for joining us. I know it's relatively short notice, but we just wanted to have a quick session, um, particularly before everybody goes off for the in that holiday period. We know that this bond is something that will close early in the new year, and people have been asking for us to do a bond prospectus review. And I guess one of the major reasons why is that we don't tend to see bond IPOs very often, and as such, this is not the typical type of analysis that is done around equities or equity IPOs. So further down into the session, we have Justin Scott, who is an investment banker at Mayberry Investments, who will be coming on and sharing with us some of the merits of the bond offering. If you know somebody that is interested in the Mayberry bond, please share the link with them. Don't forget, if you're on YouTube, don't forget to like the video and subscribe to our social media. Also, I'll be taking questions as I go through. I love when these things are more interactive. Boy, I see Monique posting questions already. No more Monique, we get into it. I love when these things are interactive. So I'm really looking forward to the session. So Monique, we're going to get to that question for sure. Just setting up, confirming that everyone can now see the presentation. Let's wait for a confirmation there. I believe everyone can see it. It's up on the screen. All right, let's go. Let me know if you're having any video and audio issues. Remember, post your questions while they come, and I'll do my best to try to address the ones that I can, and we'll save them for the for Justin himself when he comes on. All right, so let's just get into the meat of the matter. What are bonds? Now, bonds are fixed income instruments, and that's just one part of the overall investment scale. A good amount of us have been used to what we call stocks or equities, and these are ownership stakes in companies. So you have listed companies like a Barita, Edifocal, Wicton, Mayberry Investments as well. And these companies issue pieces of themselves or sell pieces of themselves to shareholders, and shareholders benefit from owning the shares of these companies through either dividend payments or an increase in the share price. So we've gotten pretty used to that. Fixed income instruments are a bit different. So, one, they are issued by the same companies and they don't tend to be traded. We get into the trading of this particular fixed income instrument. Now, the fixed income part of it is self explanatory, but they provide some consistency over when you will get money. And we're going to get into that right now. So, let's just go into again, as I said, what's a bond? A bond, I like to think of it as a fancy way of saying a loan because it's almost the exact same thing. It's a promise by a borrower to pay a lender back their money over a period of time, and they pay their money plus some form of interest. So as I started to mention, bondholders get a steady income until the bond matures, meaning when a company issues a bond or they're borrowing money through a bond offering, they will say, we are borrowing this money for 2 years, for example, or we are borrowing this money for 10 years. So the expectation is that you will get back interest on your money over the period, and this is the steady income part of it, or the quote unquote fixed income. And you know how much you'll get back in many cases over that period of time. And the principal can be paid at the end of the period, which is what this company Mayberry Investments will do, or you can pay it back over a period of time. So, for example, when you go to the bank and they give you a mortgage on your house, and for a mortgage payment, when you pay your mortgage every month, you pay a piece of interest and principal, and after 30 years, you don't have any principal to pay. That's the bank giving you a loan or a mortgage. So effectively, Mayberry Investments is saying, guys, we want to borrow some money from you at this particular rate, and we will provide back this money to you in X period of time, and this is the interest that you will get. Bonds can be issued by companies such as Mayberry Investments, your Barita Investments, your Seprod, any type of company really. And it can also be issued by governments as well. We're not getting into that. Now, I wanted to highlight the main differences between fixed income and equity. As I said, I'm taking it from this perspective because I know some of you will already be familiar with what equity is, and this is a bond IPO. So over the past few years, people who have just started to come in the market would have probably associated an IPO or an initial public offering with equity, not knowing that you can also have a bond IPO. Bond IPO just means that this is the first time the bond is being sold, and after it's sold, it can be traded on the stock exchange, just like a stock. And as I said, Justin will be joining us to explain that in a bit more detail. So for fixed income, the issuer commits to pay to pay an amount. It's not upfront, sorry. It's over a period of time. The price of the bond is usually less volatile. So bonds don't necessarily trade when they're traded, trade as often as equities do. So equities trade almost every second and minute of the day. We tend to find that bonds are a bit slower in trading. So the people that buy bonds tend to buy them for the income and not necessarily to buy and sell over a period of time, even though this bond that is possible. If a company defaults, bondholders, and defaults here mean they just can't give back your money or they violate some form of agreement that they had. Bondholders get paid before equity holders. So if there is any trouble, bondholders are ahead of equity holders. So God forbid if something happens to Mayberry and they're in a situation where they are in default and they can't pay their creditors, bondholders would be first in line ahead of the equity holders that are in the market. That's what that means. The initial investment is usually higher for bonds. For this one, the initial investment or the amount, the minimum investment is actually pretty low for bonds. It's about $20,000. I know that sounds high, but it's pretty low for bonds. I mean, I've seen bonds have minimum amounts of probably 100,000 US dollars. So this 20,000 Jamaican dollars is pretty low. As the liquidity being low may just mean that a lot of people buy the bond with the anticipation that they won't necessarily trade it or sell it, but they actually want the income from it. That's what they wanted. And as such, this may be traded a bit less. Whereas with Mayberry Investments equity, somebody may buy the stock on the market with the expectation to buy it now at a lower price and sell it at some future point. So their expectation is not necessarily just dividends, but to sell and get and earn on that trade or get capital gains. Now, as with every investment, there are risks to owning bonds. Now, the one of the most important things to ask Mayberry or any company that's issuing a bond or that's borrowing from you is, will you have the ability, or to assess, will you have the ability to pay me back? So that's a credit risk. If the issuer is in a position where they cannot pay principal and or interest, so in your assessment of whether you want to participate in this bond offering, you have to think about, do I think that Mayberry is a good credit to lend my money to? And we'll get into that in a bit more detail. Reinvestment risk really speaks to when you're getting back principal or interest. So every quarter when Mayberry gives you back your interest payments on this bond, what are you going to do with it? If you're in an environment where interest rates are going lower and lower, it means that when you get back your interest payments every 3 months, you will have to reinvest that cash, assuming you're going back into fixed income at a lower and lower interest rates, right? So there is a risk that you will earn less money when you get back that cash. I guess this is somewhat mitigated by the fact that the principal is actually going to be paid back at the end. So you won't be getting back a part of your principal, but parts of interest. Liquidity risk. As I said, the liquidity risk here is lower than the average bond, because while the liquidity risk speaks to an inability to sell, Justin will go more into detail. This bond will actually be tradable on the stock exchange. So once there is somebody that if you buy $50,000 worth of the bond, once there is somebody that's willing to buy the bond, if you decide, look, I want my $50,000, I have to go fix my yard, or I have to fix my gate, or somebody lit my car, you can go on the stock exchange and sell this once there is somebody that's willing to buy it, right? Interest rate risk. This is just the change in interest rates leads to fluctuations in the price. So if it is that interest rates are getting higher and higher, then the relative attractiveness of the bond will be lower and lower, because instead of going in at 10%, if interest rates are, for example, at 16%, you can sell the bond on the market and then go into a much higher interest bond itself, or into a higher interest security. So when that happens, what happens is that the price falls. So it has what we call an inverse relationship there. And that's just a simple way to explain that. Of course, as you realize, I'm just going through very high level. You can post any question that you have in the YouTube. I'll do my best to answer. And for the really difficult ones, I'll save them for Justin to answer. All right. So these are some key terms that you must remember. These are very important. Started to use some of them already to sensitize you to them. Issuer. Issuer is the company that's selling the bonds. Or in other words, issuer is the person that's the company that's borrowing the money from you. In this case, the issuer is who? The issuer is Mayberry Investments Limited, because Mayberry Investments Limited is borrowing the money from you. Now, why they say the issuer is the company that's selling the bonds is really and truly, think of a bond as a piece of paper. What they're doing is they're handing the piece of paper to you and saying, we promise to pay you back this amount that's on that piece of paper, and you're handing the money to them. So technically, they're selling the bond, which is that piece of paper, to you. So that's a very simple way of thinking about when people say they're selling a bond or they're buying a bond. Tranche. Now, when companies want to issue bonds, but they want to expose bondholders, or you can call them investors here, or lenders, to different types of risks for the same types of for the same bonds from the company, they can issue them in what we call tranches. So tranches is basically, instead of one big bond, you break it up into multiple bonds, and you say this bond, or these bonds are for 13 months for X%. These bonds are for 2 years. So let's say Justin prefers to invest for the very long term, just had a baby, and he's thinking about the child going to college. He can say, look, I prefer, Mr. Berry or Mr. Peart, I prefer to have a 20-year security. And they may say, okay, fine. But Simon may prefer to have a 1-year bond. So I want back my money in 1 year. Justin doesn't mind getting back his money in 20 years. So you can have a tranche that's specific to Justin, that says this is tranche 2 for Justin. He will get back his money in 20 years at this interest rate with these terms. And this is a tranche for Simon. Simon wants back his money in 1 year. And for that 1 year, we'll pay this interest rate. So tranches kind of segregate the bonds into different pieces. As I said, very simple way of looking at it. Collateral. This is something that is pledged as security for the bond. Maybe he's saying here, if I'm unable to pay you the monies, then I'm borrowing that. You can claim on this collateral. So a good way to think about collateral or security is when you do a mortgage, or let's even use a car loan. When you do a car loan with a bank, the bank says, look, I want the car as security. If you don't pay your money, or if you lose your fancy job on Knutsford Boulevard, I want to be able to claim something. So if you don't pay the bank for 3 months, right? If you don't pay the bank for 3 months, then what happens is that the bank may very well come back and say, hey, I want to claim the car. I'm going to sell the car and pay off whatever else you owe me. Here, the collateral is that same thing. It's a security. So we'll actually get into that. Interest rate. So this is the gross amount, and I say gross because it doesn't the rates that you're seeing doesn't account for taxes yet. So you have to net taxes. So if the rate that you're seeing is 10% and taxes are 25%, then that means that you're really only getting 75% of that after taxes. Upsize. Now, people that have invested in equity IPOs may understand this word. Upsize means, guys, I know that I'm coming to you for $5. However, I wouldn't mind getting $7. So if there is a lot of interest in this bond or this IPO, then and you give me $7, then I want the right to keep the $7 or upsize from $5 to $7, because I also have use for that money. So upsize just gives the company the right to increase the amount that they're telling you. And I believe the amount here can be increased by 2 billion. Covenants. May, covenants are effectively terms that the company is promising not to breach. So for this, you have a covenant around leverage and you have a covenant around liquidity. I'm going to show that to you in a few. So let's get into the Mayberry bond. So let's go into more details. So I've been explaining what a bond is to you by using, things from the actual Mayberry bond. So let's go into that in a bit more detail. So Phil, I see your question. I'm going to hold your question until a bit later. And I'm gonna put Marlene's question first. But Marlene, let me just introduce the one to you first. Now, one of the biggest things that I always ask is why? Why no? Why is the company choosing no to raise debt? Interest rates are very high. It would seem that it would be best to wait until interest rates are lower in order to raise debt, because at that point then the amount of money that the company will have to pay you in interest would be less, but the amount of money that they're paying you now is relatively high. This chart gives a very high level summary of what has been happening in the economic environment. So overall, so outside of Mayberry, outside of the just the financial industry, this has been happening in our economy. Now, the thick blue line represents inflation. For a good while, from January 2020, for most of the time, inflation has been where the BOJ wants it, right? Between 4 and 6%. Coming out of 2021, for various reasons, increases in commodity prices, early 2022, the war in Ukraine, and resultant effects from COVID as well, inflation would have started to increase. Now, when inflation increases, the BOG or the central bank has to respond, and this is in their words. How they respond is that they increase their policy rate. The policy rate is the rate that they lend to banks, and it sends a general signal to the economy that look, you need to be increasing the rates as well. So what happened is that the gray line here, the policy rate, it was flat for a good while, 0.5%. Very, very cheap. Interest rates were very low. But you realize almost as soon as inflation started to move, the policy rate started to move as well, moving from 0.5% to about, it's at 7% now, right? So this is a bit dated. It's at 7% now. What happens is that on top of the policy rate, the Bank of Jamaica is saying that I want to limit the amount of liquidity that's in the environment. And let's just call that liquidity cash. I want to limit the amount of cash that is out there. So I'm going to do things in order to limit the amount of cash that is out there. What happens is, as less cash is in the economy, the cost of money increases because resources are limited. So what has happened is that there has been an increase in overall rates and a reduction in overall liquidity. So that has put a lot of companies in the position where they need a source of cash in order to pursue various business activities. And I believe, and I'll ask Justin as well when he comes on, that that's one of the reasons why Mayberry would choose to raise cash at this point. Now, important terms of the offer. And Marlene, your question, I'm going to answer it on this slide. And Monique's. There are four tranches, as I mentioned to you. Remember, I was saying that tranches really just mean it's different parts, different bonds combined into one. So the different tranches are expected to cater to different people. So you have a tranche four, or call it a pool four, that is for 3 years. They're all raising the same amount, 1.25 billion. But you realize because it's for 3 years or 36 months, the amount of interest that they pay you is more. So for 3 years, you'll get 12% because the opportunity cost of them holding your money or the sacrifice or what you could have invested your money in, you demand a higher rate for them holding it for a longer period of time. So it's 12% if you do 3 years, and it's 9.25% if you choose tranche one, which is just 13 months. Call it a year and change. Now, the security is a charge over Mayberry's secure loan book. So this loan book is effectively loans that Mayberry has issued. They are using those assets as security to issue this bond, and the use of proceeds is to expand its portfolio of securities of loans for general corporate purposes. So they want to use this money to be in a position to issue even more loans and to invest in even more securities. So I think Monique, I answered it there. So Mayberry is effectively going to use the money to issue more loans and invest in more securities. So I wouldn't be surprised that after this issuance, you see some form of loan sale over there or some form of activity around marketing, selling loans, or some specific activity of them investing in something. This may be for a specific reason. And I'm gonna push that to Justin. I know you won't answer, but I'll still ask. So what is not on this slide, Marlene, but I'll answer here. If they call the bond before maturity, will they compensate us? Right? Now, I want to explain what calling means. So for this $5 billion, you are going to give $5 billion to Mayberry. They're going to give you your bond agreement, and they will have that money. It may be that next year things go extremely well for Mayberry, and they say, you know what? I'm going to pay out this bond. I don't want to have this debt on my books anymore, and I'm going to pay out this bond. That's what they mean by they're calling back the bond. So effectively, you're saying, all right, come back, come back, come back. I'll give you back the money, or I'll give you a portion of the money. If they call the bond before maturity, will they compensate us? My understanding, based on the prospectus, is that the principal, if there is early prepayment, or if they call it, or early redemption, there will be no prepayment fee. Meaning that they won't pay you a fee for calling back that. No, some people don't mind that. Some people do, because what happens is that if you give them $10 million, and you expected to keep that for to have that in this bond for 3 years, and after 1 year they say, look, take back your $10 million. We are moving down another path, or we're doing something else. What happens is that you now have $10 million plus with your interest, and you will have to find something else to invest in. Now, not everybody wants to be in that particular scenario. How much do you think would be a safe amount to invest in the bond, knowing that cash could be useful for IPOs? Well, Justine, this is a good question. I'm sure Justin will answer this. I have to be careful in how I answer this, because I don't want to give any form of investment advice here. I would say, speak to your advisor. Justin just, well, when he comes on, I'm gonna ask him if he still has the investment advisor certificate, so he'll be able to tell you this in a bit more detail. So effectively, Justin is saying cash is limited. Simon, cash is very limited. How much money should I put in this bond, knowing that there's likely to be IPOs coming within the next, if let's say Justine wants to go in tranche one, which is 13 months. If there are likely to be IPOs coming in the next 13 months, Justine is asking, should I just hold on to my money, invest in equity IPOs, and get a higher return? or should I just put my money here? I think what I'll say, Justine, is that depends on your ability and willingness to take risk. Equity investments are more risky. However, they and consequent to that, the amount of risk that you take on, the returns are higher. I believe bond investments, particularly for this one, are for people that are a bit more conservative, where they just want to put their money down and receive income on it, right? But as I said, that's a question I'll pose to Justin as well. Yes, so the minimum subscription here, as I mentioned, is $20,000. The financial covenants are maximum leverage is 4, minimum current ratio is 1.2, which means that if the company goes, if their maximum leverage goes above 4, this becomes an issue, and there can be an event of default, as we say. Default meaning that legally they're saying that, look, you have to pay back the people their money, or if the current ratio falls below 1.2. What I didn't see in the prospectus, and again, this is a question for Justin, I didn't really see where they estimated what the historical and future leverage and current ratios will be. For financial companies, it's a bit more difficult to calculate a current ratio. Matter of fact, I don't usually see a current ratio being used for financial companies, because the assets aren't immediately classified as current assets and current liabilities, even though it's possible to do it, right? So you would have to know which items are current in order to calculate them. And boy, I couldn't go through the rigor of doing that. So it would have been good to see that as well. So I put the 5 C's here. I know a lot of us learned this at school, because this is kind of how you look at credit. You look at the character, determined by the credit history. Does Mayberry Investments have a good credit history? The capacity, can Mayberry Investments really afford to repay the loan? The collateral, which you spoke about, are the assets sufficient to secure the loan, the bond that they're doing now? Capital is the ability of the company, not just the payback, but the capital strength of the company to cover any adverse events, and the other conditions, which are what I stated as the important terms. So even though this slide, these 5 C's are particularly for individuals, I think the most important thing that you should ask yourself in considering the Mayberry bond and any other type of bond offering is, can Mayberry afford to pay me back my money when it comes due? Now, generally, Mayberry Investments was started in 1985. It's a securities dealer, and a member of the Jamaica Stock Exchange since 1985. So Mayberry has various business lines. I believe it would be fair to say that Mayberry has listed probably the most companies on the stock exchange as a securities dealer. So they've done a good amount of work, particularly on the junior market. They have an experienced team. The board is chaired by Mr. Christopher Berry. If you're on Twitter, you'll know him as Guru Jammy. The board, also on the board, you have Conrad Berry, you have Mr. Erwin Angus, and various other directors. What I'd point out here is that the breadth of experience here is wide and varying. So you do have people with a background in auditing, accounting, capital markets in particular, trading. So this is a pretty wide and decent variation for a board for a company that deals in these 3 main areas, which is treasury, asset management, and investment banking. Now, this is in the prospectus. I actually want to look at these charts from another perspective, because when dealing with bonds, even though historical capacity or their ability to pay, um, historically, is important, I think that the forward-looking statements are also just as important. How will they be able to pay these back over the next 13 months, 24 months, and 36 months? So, generally speaking, the financial statements for financial companies tend to be a bit hectic. I'll just put it there. So they require a bit more understanding than your normal manufacturing and distribution companies, and they tend to start with the incoming interest income, sorry, and interest expenses. So prior to 2021, Mayberry has seen a consistent increase in their net interest income over that period. The net interest income is important because this is typically, I mean, to my understanding, almost always cash based, whereas below the line, as it pertains to unrealized gains, which are recorded on the books in profit and comprehensive income, are usually non-cash. So you may see something here that's for negative $3 billion, and you say, "Oh my God, they lost $3 billion," when really and truly it's just the value of a portfolio went down by $3 billion. So they didn't lose $3 billion in cash. So onto that same point, the company would have suffered a decent losses in 2020 due to these unrealized losses in their investments. And I put it I put it as investment related assets because it's really related to their investments in their associates and the financial instruments that they hold on their balance sheet. Now, interest expense for this bond going forward will likely be reflected in what we call the top line. So at the top of the statement where you have interest expense. I pointed this out because usually when you look at other companies' financials, non-financial companies' financials, there will be a line item for finance costs or interest expense, but it will be closer or below operating profits, so down here, which is why I was saying financial companies, the statement itself is a bit different. This is their year to date, well, the 3 month numbers as at September 2022. So you realize here the company also had quite a few unrealized losses on their investments in associates and financial instruments, and this would have translated through their statements. Now, I want to state here that this income statement is not a perfect reflection of cash, right? So a loss of 2 billion or 2.2 billion, sorry, or an unrealized loss doesn't mean that they lost cash of 2.2 billion. But certainly it would be important for the company to highlight the challenges that they would have had here, and know that they would have done that to some extent in the prospectus. My personal choice would just be for that to be more in detail. The balance sheet is here. I mean, I looked at the balance sheet over the past 5 years. The company does have a relatively robust amount of equity. This is their net assets. So if you take away liabilities from assets, that has grown from 9 billion to 21 billion. So in my opinion, and just based on my very high level, I wouldn't say that there's a material credit risk with Mayberry investments. So that's my first feedback. Um, Now, what an interesting point that I realized is that if you sum up all the interest payments per year, the interest payments come out to indicatively or approximately, sorry, about $528 million. No interest payments are cash. Now, I guess a question that I would probably put to the company is, how do you expect to get this $528 million dollars? No, it's good that in the prospectus they actually started to answer that, where they said that this $5 billion, and I'm using the minimum amount here, will actually be invested, sorry, in loans and other investment securities. Now, to my other point, the weighted average loan rate, or the average loan rate or bond rate, interest rate that you're doing here is about 10.56%, assuming no upsides. It means that on average, on average, the loans that are issued or the investments that are made would have to yield more than 10.56%. In my personal opinion, um, these rates are pretty decent, and they are matched to the high interest rate environment. Now, the Bank of Jamaica would have started to um, they would have started just the last decision, they didn't increase the policy rate. I personally believe that inflation will be tracking down from where it was at the peak of this year, which is almost at 11%. And the BOJ believes that as well. This is from their last statement. Now, that doesn't mean that the inflation for that period won't go up periodically. But I just believe that where rates will be in 2023 and 2024 will be relatively lower than where it is in 2022. So there is some likelihood that Mayberry will refinance or pay back this bond before 3 years. That's just my personal opinion. As Simon, that's my personal opinion, right? So yes, another thing, because it's publicly traded, and Justin is telling me that this will be on JTrader, so you can click on this and buy and sell, like any other security. I'm actually interested to see how it will trade. Now, a risk here is that because it's tradable, the price can go up, the price of the bond, and the price can go down as well. So that's something for consideration. What I want to do though is I want to invite Justin in now, and just field a few questions to him about the offer itself, and then take some of the questions that you have had. So I'll try to answer the ones that I can, and I'll pass on the much harder ones to Justin. Justin, welcome.
I'm glad to be here, Simon. Can
Yeah.
everybody hear me?
Well, I can hear you. Somebody can confirm in the chat. But Justin, I see the Mayberry band offer all over. I saw it on TikTok today, saw it on Instagram, seeing stuff on Twitter. I even see Miss Kitty in half a tree. Tell our viewers what's the what's one what are the investment merits of going into this Mayberry band?
Okay, glad to great question, Simon. All right, so yes, as you would have heard, we are very public with this current with the current bond IPO that we're raising right now. And one of the merits is that, well, firstly, I want to just address that we are offering this bond out to the wider public, and bonds are a great opportunity for people to invest for, especially those who have maybe a bit more of a conservative investment outlook, especially considering that you're going to be in it for 13 months up to 3 years, right? And so, for example, now if you're the type of person who would have had money sitting down in a bank account that has only been earning like 1 to 2% per year, we're providing you a great opportunity to further invest that funds into something that is much more interest bearing. It's a great opportunity for those type of people. And it's good because Mayberry, as I said, this is a secured bond, or as you would have highlighted, this is a secured bond that is secured by our loan portfolio. I saw some questions regarding that earlier, so we can touch on those when it gets to answering each individual question. But so it's secured, it's high interest rate and savings, as well as it's going to have the added benefit of being able to trade on the actual local market on JTrader, right? So for all the people now who are looking for a security that has much more liquidity, to trade regularly, for example, even people that are trading high values of funds, it's a great opportunity for people to reach out, utilize that, as well as it's going to bring life to the bond market. So, for example, now when a client of ours, or typically anybody, is looking to raise a bond and they're seeking to raise some funds, right? Normally they go for accredited investors or do private placements to seek that money from these borrowers. However, now it's a much more public offering. That's one, increasing the amount of financial inclusion to our society and allowing people to get the benefit of investing into bonds, having some stable income coming into them, even if it is just a small sum, and to get the experience from there. But then also so that our clients can then also get to understand that we have a wide investor base in Jamaica. People are here, people are ready to further invest in the funds, and then they can have more offerings like this where people can get more secure investments that can provide them income that perhaps they want to be listed on the on JTrade and other and the platform as well, and that's going to provide a lot more opportunity for the people.
Thanks for that, Justin. Marlene is asking if tranche 4 is closed.
No, we wouldn't have. No, no, I wouldn't say transfer is closed as yet. So you still have opportunity to go and invest into the 12% per annum security, which is the 3-year note.
When
We will
when when
announce when any of the tranches are closed. But
Okay.
I can tell you that it is first come first serve. So if you do have an interest in investing in one of the bonds, like more particularly the 12% one, I would advise you to get right up on that now, because when they do close, then that's it, guys. You have to move on to the shorter interest rate. But so all of the people then who would have been concerned about, oh, they don't want to tie up money now because they want to wait until maybe a little bit later to see what they're doing. People like to feel things out sometimes, but just acknowledge that you do accrue interest by the day up until the point when it actually does open. So if you send the money from tomorrow, then then the process begins from there.
Thanks for that, Justin. Before we go to Phil's question, when do you guys expect to close? Is this going to close before? Are based on your vantage point, are you seeing indications that this will close early, or are you guys sticking to the January date?
Well, chances are we will stick to the date. However, some of the chances will definitely be closed from beforehand. So, for example, now the high interest rates ones are definitely a big favorites for a lot of
Okay.
the institutions and higher net worth clientele. So, if you don't be surprised if you announce that tranche 3 and 4 are closed quite early.
Okay, and I guess another thing I want to point out is that this is what probably the institutional guys will call repo eligible. So it's listed on the public market, but it's issued by a securities dealer, meaning that institutional investors will have the ability to purchase this bond and then issue repurchase agreements on said security. So that itself may add a level of attractiveness to
Absolutely.
the offer. Phil is asking if I hold a bond, if I hold the bond and let's say, I want to sell it within 1 month, will I receive the pro rata portion of the interest, or is it more like a dividend where the holder as at X time gets all the interest?
Good question, Phil. Great question. Yes, it would be the pro rata portion. So the way it's going to work is any accrued interest on the bonds will be calculated from the date the client purchases the bond to the maturity date or the date the client sells the bond. So if you decide that you want to take tranche 3, but you only want to hold it for 4 out of the 24 months, then you would have gone through a full quarter, and then you would have had the additional month of interest accruing towards you.
Okay. So someone is asking, how is it that this will benefit low income people? I'm trying to find the exact comment. How is this expected to benefit low income people? Why should low income people be investing in bonds?
Well, the first thing I will say to that is I do believe that everybody should be investing regardless if they're low or high income, but the vehicle can be different dependent on the person's goals. So if somebody now is if everybody has a different situation, right? So if you're the type of person now who perhaps you have been saving money in say a bank in a commercial bank's savings account, and it's just been there sitting down, and perhaps every month you throw $5,000 or $10,000, but at the end of the year realize that maybe I have like 50,000 or so put down, and you're just going to continue along that path. It's going to be much more difficult for you to actually amass proper savings without actually having the benefit of the interest upon it at that point. So even if you are at that the bare minimum of the $20,000 and you are seeking an investment to use it on, if you're not the type of person who can manage the volatility of say stocks, and you are just looking for some income or you're just looking for something to continue to build upon it, that is better, right? 2% from the bank on a higher level versus I don't know, like 9.25%, 10% and further. It's a lot better for you that way.
Yeah, and my personal opinion on that is, and Justin, I think you said it pretty well. It really comes down to one's own investment goals, and
Exactly.
their ability and willingness to take risks. There are investors that just are not suitable for taking equity risk, and as such they would prefer something that is more fixed, which is why there are low income people that go to a bank and say, look, what can I get in like a time deposit, or a certificate of deposit based on the minimum amount. So if they're in a position where they can earn a certain amount of interest on money that was earning less interest,
Exactly.
then that's dependent on their particular goals. Now,
Yeah.
what I'd also say is that an investment in investing in equities or stocks doesn't mean that you can't invest in bonds, or fixed income instruments as well. So people might have different portfolios for different things. So Justin, you may have, I know you guys were maybe are very wealthy and you get some very hefty paychecks, right? I just troubling you, right? So you may have some money put down that you might not want to, because you want it in 3 months or you want it in a year. That money cannot be less than what it is in a year. So a bond probably gives somebody a bit more security, pun intended, around having that money in 1 year plus getting some form of interest on it.
Absolutely. And I'll also add, Khadija, that an added benefit of it being able to be traded on the public market is that you can always buy additional units into the bond from there on out, and that's going to increase the payout for you once the interest continues to accrue.
Yes, yes, yes. So some Marcia is asking, putting 1 million for 3 years, what would be the turnaround? I think Samaria is asking here, or might be asking here. So if she put on $1 million for 3 years, you're saying that she's going to get 12% before taxes each year?
So I also want to point out, I do want to point out that there are taxes associated with the bond. So it's not a direct 12%. So for example, I can actually break it out for you. I have a calculator on here somewhere. But
Mm-hmm.
so it's not the direct 12%. So the tax rate is about like 25%.
Yeah, they'll
So
be withholding 25%. Yeah.
yeah, there is a withholding tax applied there. So that is something to be considered and kept in mind. So I believe her direct question was what, 3 million,
Well, a million for 3 years.
or a million for 3 years.
Mm-hmm.
Yeah. So the 3 year notes. So that's going to work out to be the yearly pay would be about like 90,000 JMD, or as far as quarterlies go, 22,500, and then the cumulative total payout on top of that $1 million over the course of the 3 years would be $270,000.
Okay, so so Kurt is saying that that's basically if you take out the 25%, which I believe withholding tax is a part of the actual word withheld. So the company or the trustee that is paying out the interest will actually hold back the taxes and send that to the government and send you net of taxes. Similarly to how dividend tax is done, where you
Yeah,
don't get all of the money and they say, well, you go pay your tax. They take it out before you get it.
yeah. The government still does have to take their bonus.
All right, so Marlene is supporting your calculation here with her calculation as well. But Arville is saying, look, Justin, me hear you talk about 12% a year, but I'm a shooter, right? When I'm on the
Mhm.
market, I can make 12% a year easy in the equity market, right? What would you set to Arville?
Orville, first of all, man, congrats, right? Because globally, those are globally for a lot of funds, 10% to 12% is about par for what they'll be offering you as far as funds will go. So if you can do that on the market, then what's also stopping you from buying into the bond and investing into it and trading the bond just the same, right? Because there will be opportunities there. Think of a scenario if think of a scenario if within the next couple of months, I don't want to put an exact date on it, that interest rates start to trend downwards, right? And then bonds, imagine seeing interest rates go down to like 4% or lower. And then here we have Mayberry with a 9, 10, 11, 12% note upon the market. It's going to trade at a premium. So you can then know if you were in from before and you're anticipating rates going down, maybe have a good pulse on the global market and anticipate something like that. Then you stand a good opportunity to benefit from trading a bond just like you trade a stocks, right? Because interest is interest. And if you're that sharp of a shooter, then by all means, man, don't limit yourself.
And I mean, I'd probably be a bit more frank, and I'm speaking generally about not just fixed income instruments, but other types of securities and everything of you. You know,
Mm.
so if you know that you can go into a market and make 60% a year, um, based on the amount of time and energy that you spend there, and the overall net reward to you is way more than 12, then the best use of your energy and time might be to do that. But there are people that just don't have the energy, time, or even the background knowledge to
Right.
be able to execute on that in particular. So Monique is asking a question here. Can you explain how a loan book can secure these loans? I mean, I can take this one, but you can go ahead. Just
All right, cool. So Simon would have highlighted earlier that the use of the proceeds is to go towards our own loan book. Mayberry is very much, very much one of the, well, I don't want, I'll say our margin facility is one of the best in the industry, right? It's very flexible, but also it's very intuitive, right? And so what we'll be doing is we'll get the proceeds and we'll then be on lending it further to our other clients. And so we have a lot of high net worth clients here. It's not uncommon for us to be giving out margins in the tens of millions or even hundreds of millions to clients to then now purchase other securities. In addition to the fact that Simon brought it up that if according to Simon's calculations, our yearly payout would have been about 10.56%. That's correct, Simon.
Yes,
Uh,
average. Yeah,
yeah,
loan.
our margin facility is 15% per annum. So there's that spread there that we will be able to then now secure ourselves, ensuring that we can make the payouts and manage them. In addition to the fact that the underlying securities of the loans that we hit out are margins, based on say stocks or the bonds, that we can then know because we would have lent it out a margin, we have certain rights to these securities that are held within the loan. So for example, now if it's non-performing and we do have to issue say a margin call, then we would then now recoup a good amount of that investment, and the amounts, the market value of our assets is far greater than the actual um amount that we're raising, right? So it is secured by that, and that's how we can manage it.
Okay. Devon is asking with respect to the use of proceeds, how profitable, I think you have probably answered that, and how popular is Mayberry's margin facility?
I'm sure if you ask a lot of people who would be in the industry, that are especially regular traders or equity traders, they can tell you about how the margin facility works, and they can speak from own personal experience. It's fairly popular. Mayberry was primarily more of like a higher net worth clientele institution, more of like a boutique firm. So that's kind of who we're working with. So it's fairly popular. We do a lot of high value loans, and it's I think it works pretty differently, but also favorable to actual investors in terms of how we go about doing the margins. If you're actually interested, you could, come down to Mayberry, open an account with us here, and get the experience firsthand.
All right. So shoot a message to. Well, don't shoot it to. Well, if shoot it to Justin and he'll direct it to the right person.
Exactly. You can reach
Investment
out to me.
banking. Yeah, man. Investment banking, them money at the no, so you can pass on those sales things. All right. I think probably an important point as well is margin loans don't have to be $10,000 and $50,000. You have
Yeah,
margin loans in the tens of millions of dollars.
yeah.
And if the risk appetite is there for the company, I do not work at Mayberry, probably well over $100 million as well. So there are various ways to deploy the money. Um, ah, so Samarcia has a good question here, which I've been expecting. Do we make a loss if the bond declines in this? Well, when stock market here, meaning when it trades on J
I
Trade.
understand on the public market or on the public platform.
Mm,
So if you were to sell the bond on the market, if say it drops below par, meaning the issue price, then yes, there would be a loss. However, if you're holding on through to maturity, it's going to be redeemed at the offer price. So it's only if you only were to sell before it's actually matured. If you hold to maturity, you get back your principal, and you would have had interest payments coming to you. And but yeah,
yeah, yeah. So I realized that Justin expertly use the investment banking sense to give you bad news, but immediately add great news to that. So it was actually one of my, I would say, concerns, because that's just how it works. I mean, any company that
that's
would
how most
issue
investments work. Yeah,
publicly, yeah, that's how it works.
it's
But
nature of it.
it's a risk factor that I believe the company would have pointed out in the prospectus, and it's certainly a risk factor that anybody that wants to purchase in the bond will do. I guess my question, or probably general point, is my expectation is that if this will go into issuing more margin loans, I would not be surprised to see some um some new type of margin facility come, or innovative facility to deploy or to lend out the money in margins. If we are still in a market where equities are generally trending down, that may be of consideration to the company. But I guess that is somewhat mitigated again by the company doesn't do margin loans one to one. It does margin loans as a percentage of the amount. I think last time I checked, it was 50% of the amount.
The value of the portfolio.
Yeah, man. Devon is asking if in 1 minute you can give a quick rundown of the margin facility at Mayberry, given that the margin facility is important within the context of what of the use of proceeds of the bond.
All right, fair question. I can just give the basic rundown. So, for example, it's 48% of the value of their portfolio and 15% interest on that margin per annum, right? So for example, you have $1 million portfolio, meaning you have $1 million worth of marginable securities. You can get, say, $480,000 paid out to you, and then you pay out 15% on top of that $480,000 per year. Bear in mind that it does accrue interest, once it carries over into multiple years. But the benefits is one of the ways how we're flexible. We don't necessarily um, you are able to then know, you're still able to say sell the stocks, and that can be used to recoup the investment. So say for example now, you would have
So you
invested
don't pledge,
you don't
the.
pledge it, right, that's what I was looking for.
Mhm.
So if you were to say invest that $480,000 into a stock, and you wanted to sell because you bought the stock at $1, it reached $2 now, and you want the money same time. You don't have to go through all of the lengthy process that some brokerages may have when you have to issue the request to unpledge the shares and then wait on that, because by that time maybe the volatility of the market same way would, reduce the amount of profit that you're able to make.
Right. Thank you, Justin. I don't see any other questions coming in. I believe that we answered everything that was there. Guys, thank you for coming. I want to especially thank Justin for coming. I know it's not early, and he probably has his deals working on. So I appreciate him being here to share with us. This was just a general review of the prospectus. Remember, whatever we spoke about today, there's a lot more detail in the prospectus document, and you can find that on Mayberry's website or on the Jamaica Stock Exchange news website. Remember to subscribe to the page, like the video. Also follow us on social media now. I'm gonna go into the Telegram group now and talk a bit about the bond. Sure, Arvin will be there. Playing devil's advocate as usual. But we really appreciate you being here. Justin, is there anything you want to leave our audience with?
All right, yeah, man, definitely. So I just want to say that this bond right now is a great opportunity for anybody who is looking for that kind of investment. For fixed income, somebody who, maybe have a family member who all they know is savings and isn't looking to get into anything risky, and they just want to find something where is a nice, proper opportunity from here. So further from there, if you guys are interested, you can go and check out www.bondberryja.com, where you can see the prospectus, the brochure, which is a nice summary of the offer, and further from there, the actual sign-up instructions. Easy as 1, 2, 3, guys. So you can hop on, and you can go through the process, and you can make some money with Mayberry. Simon, I think you're still muted.
Yeah. Sorry,
But I
Rihanna is saying, Justin, that she wants you to be the one that you contact. Is it possible for people to contact you through your socials or send them directly to the website?
I can send them directly to the website. I am available on socials if you're, for some reason, unable to reach me at Mayberry. You can always call down to the front office and ask for Justin, and they'll put it right through to me. And I can, address any questions, concerns that you may have. I can discuss anything further with you. I am no longer a investment advisor that's handling retail clients, but we have some great advisors on the sales floor that are definitely able to assist you with any one of your concerns or anything or investment needs. So they can get it signed up if you want to invest into stocks, if you want to invest into bonds. Some great talent out here at Mayberry.
All right. Thank you so much, Justin. Thanks to everybody that came out. See you in the Telegram group. Remember to join the Telegram group or whoever hasn't already. And I really appreciate you guys taking the time. All right. Take care.
All right. Appreciate it, guys. See you next time.